Hello, this is Orrin Smith with Palmetto Promise Institute, and it's my pleasure to be with you today to talk policy. You probably have seen our Palmetto Freedom Agenda. This is the brochure on the Freedom Agenda, and it's full of all of our ideas for this legislative session. Of course, we're halfway through a legislative session, and some of these ideas are already moving, but others are not. But we're conducting a series of webinars in advance of the 2026 legislative session to let folks have a little bit more in-depth dive into some of the issues that we perceive as important. And our issue for the day is under free market and economic opportunity. Also, we just call it tax and budget. So this is a briefing on primarily South Carolina tax policy, and looking forward to presenting that with you today. So if you're live with us, please feel free to give us a message through the chat. But if you're watching this on a recording, please feel free to contact us at Palmetto Promise for any feedback you may have or any thoughts or corrections. You may find the odd correction on this. So let's dive right into the subject matter. First of all, our outline of what we plan to cover today. First, our outline here is the general topics we want to cover, and that's ratings and rankings from experts. The 50 states are a laboratory of democracy, and tax policy is no different. So various agencies, study groups, think tanks nationally rate all the states, and of course South Carolina has a rating like everyone else, and there's some meaning behind that. The issue of conformity with the federal tax code. Now this is very complicated, but we want to try to hit some high points with passage of recent legislation that has an effect on conformity. Basic types of taxes imposed. They're different for every state, the ratio of one to the other. We want to see what South Carolina does and see if that's appropriate. Other taxes other than those typical taxes that you may not think of necessarily as taxes, but those are interesting and very important. And then just some other fiscal policies. This is a little different from our presentation this time last year. We're covering a little bit more in the other fiscal policies category. So we hope you will appreciate that. So first of all, well, here's our famous cartoon that was published a few years ago. It's tough being in the Southeast because the southeastern part of the United States is the most aggressive as far as tax reform goes. North Carolina and Florida in particular. Florida's out there with no individual income tax, no personal income tax, and North Carolina is cutting all of their taxes. They're cutting business taxes, they're cutting personal taxes, and then they were rated by CNBC as the #1 state in which to do business. Our NASCAR racetrack may not be completely accurate there because I don't know that Georgia is necessarily out in front, but Florida and North Carolina are very stiff competition for us. So Palmetto Promise Institute has been writing about tax reform for a long time. We were founded in 2013, and we released our first tax report in 2014, revised it in 2019, revised it again in 2020. And this was the you can see the old logo there of Palmetto Promise, Funding South Carolina's Future, a practical plan for tax reform that creates equity, stability, and growth. This is a very comprehensive plan, all three of those versions, because they touch on every tax that we have in South Carolina and how to right the ship and make South Carolina more competitive for growth and investment and fairer. And we're very pleased that those studies are still as relevant today as they ever were and have been substantiated by other experts. So let's get into what some of the experts are saying, some of the ratings and rankings that South Carolina experts have assigned to South Carolina. And we will look at the next slide there that has those ratings and rankings. We have a tremendous amount of respect for the Tax Foundation. In fact, if you had one place to go for comprehensive information about tax policy in the United States, the Tax Foundation is absolutely outstanding. and we rely on their research a great deal. A lot of what you're going to see in this presentation, the base research came from the Tax Foundation. They have their tax competitive index. This used to be called the business index or the business friendly index. And we actually, in the last year, we moved up about 4 points. There are reasons why they have us in the 20s instead of the teens. Forbes, as far as a state to do business, we're level there over the last year at 10. ALEC, now ALEC, the American Legislative Exchange Council, it's kind of unusual. Over time, there's a trend with ALEC. They really like our performance, but they are always suspicious of what the outlook, what the future looks like. And I find that kind of humorous because they've been concerned about the outlook for about 15 years, but the performance just keeps improving. So here we are at number 8 in performance. They're still looking at the future and concerned about the outlook. And we've actually dropped a little bit in their ratings. And I think you'll see here shortly why that is. And then the National Taxpayers Union, our friends over at NTU, they're primarily looking at the relationship of our tax authority with the authorities in other states, particularly border states. And that's why that's called the Rome Index. It's basically an index of how easy it is for someone to live in South Carolina and work in North Carolina, or live in Georgia and work in South Carolina, that type of thing. So that's what that means. So just summarizing what they're saying, these experts who have rated our tax system. Again, we all know it. It's a headline. It was the story of the 2025 legislative session, and that is the individual income tax in South Carolina. No matter how you calculate it, it is the highest in the Southeast. It is going down, but that's still a factor with all of these ratings. Something we don't pay that much attention to as a state. You don't hear it reported much, but the state treasurer's office certainly tracks it, and that's local government debt. Our worker compensation costs, those are improving, but there's still some issues there. Do businesses here have enough access to capital as maybe some of our neighboring states have? Then this commuter remote work exposure that we referred to in the Rome Index. The positive aspects that the experts find are 3, that in migration. We're clearly the fastest growing state in the nation now. We have high employment, very low unemployment, and we have strong GDP growth year over year. So that's some of the background of how we fare in those ratings and rankings. Now, an important issue that hit in 2018 and now is hit again in 2025 is conformity with the federal tax code. And the next graphic you see here will give you an example of the 50 states and DC and how they choose to conform to the Internal Revenue Service, Internal Revenue Code. So when the Congress passes and the president signs a change to some section of the IRC, there are different relationships with the states. Some states have rolling conformity. That means as soon as the federal legislation is signed, instantly the state code conforms to that change. Others, like South Carolina, have static conformity, meaning the legislature must act on a regular basis every time the code is changed in order for those changes to take effect as far as the South Carolina tax code. And then there's another version of that that's slightly different, and that's a lag. That's a static conformity, but there's a lag, more of a lag to it that causes that conformity to be less strict and less programmatic and timely. And then selective is really a version of that. And then there are other states that have no income tax, so there's not much to conform to as far as income tax. But the thing you really need to remember is you have rolling conformity or static conformity. We have static conformity, which means it's not automatic. So looking at some changes to the tax code, and this is a duplicate slide from last year, The Tax Cuts and Jobs Act of 2018, also sometimes called the Trump tax bill. If you're looking at what's best for economic growth, what's best for the economy, what makes us competitive, there's a correct and an incorrect. And again, this is just the assessment of people that look at the tax code as to what's correct and incorrect. As of the TCJA, what most experts found to be incorrect was on 174, the smart play would be to not conform with the federal code, and South Carolina conformed. And then for 168K, bonus depreciation or full expensing, South Carolina doesn't conform, and the smarter play would be to conform. You see how this gets a little confusing, but this will be a little clearer as we move along here. As far as what South Carolina is doing correctly, 179, Section 179 of IRC, the smart play is to conform to the Fed tax code, and that's what we do. 163J, smart play is to not conform, and we don't. And then guilty, global intangible low tax income does not apply in South Carolina. And then 965, the transition tax doesn't apply in South Carolina. So there's been a new tax bill. Actually, probably a continuing resolution if we're going to split hairs, but the OBBB or OB cubed is the one big beautiful bill of 2025. So what happened with that? Well, first of all, we're back here to 168K full expensing. That's a full expensing provision, as it says here, for machinery and equipment and other tangible property. That makes that full expensing permanent, whereas at one point it was phasing out. So South Carolina traditionally has not conformed, meaning we're decoupled from the federal code. This is something we need to continue to look at, because if businesses had that full expensing for their machinery and equipment, and if we follow that in the South Carolina tax code, that could be really good for business. So that's a decision that's going to have to be made by our tax writers. And then the recent shift under 174 to amortizing research and experimental expenditures is changed, restoring immediate cost recovery for research and development. So South Carolina traditionally has not conformed. We have decoupled, but with the ability to have this immediate cost recovery for R&D, that is something we should also look at as a state. We need to calculate what the effect of that would be, but how great that would be for business and investment. And then this new 168N is new with the OBBB, and that's some first year expensing. South Carolina would have to consider that. And then the other really kind of gorilla on the block here is 179, and that's expensing deductions for small business being raised from 1 million to 2.5 million. South Carolina has typically, as we understand it, conformed to that federal provision. So we have coupled with the federal provisions in that case. So these are things that when federal tax law changes, because we have static conformity, because we couple in some cases and are decoupled in others. Generically, we are decoupled, but there are chances for making these judgments on an individual basis. Other things about the One Big Beautiful Bill is there's a higher standard deduction level. Now, that was under the Tax Cuts and Jobs Act, so it's made permanent, it's carried over. South Carolina already conformed under that, and it really should not change much as far as impact on the South Carolina state budget, because we kind of assumed it would continue. The SALT cap, this is the state and local tax cap, that has a great deal of impact in high tax states, high local and state tax states, but still there is some connection with South Carolina and 17 other states who have a tie to that SALT cap that has an impact on a person's state taxes. So that's going to be a decision. One that's very interesting here is this OBBB, temporary enhancement of the deduction for senior citizens for 25 through 28. South Carolina is one of 4 states that starts in the calculation of tax liability with federal taxable income, and for that reason, this could be in play. Now, experts at the Tax Foundation say if South Carolina conforms to this and adopts this enhancement, the $6,000 enhancement, it could cost about $181.5 million as far as lost revenue to the state. Now, our tax experts here in South Carolina may find differently. They may choose to adopt this or not adopt this. Probably the most popular or most well-known changes under OBBB were the removal of the tax on tips and overtime, and also to some extent automobile purchase interest. And if South Carolina adopted all of those, again, this is because of choosing to use federal taxable income as the basis. That means we have to make these decisions if we're going to conform to the federal or not. And you see the numbers there: 44 million for the tips, 224 million for the overtime, and then about 71 million for the auto interest. And again, these are the latest numbers that we've seen. If we have new numbers to this, or if there are any corrections or additions, we will let you know. Also, the issue of conformity is a huge question. We've had bills that have been filed and passed in South Carolina that were multi-page bills that go through each section of the IRS code, the IRC, and make determinations. And this time, I think it's going to be a little bit of a challenge for the House Ways and Means Committee and the Senate Finance Committee to make some of those decisions. So, taxes in South Carolina. If you're paying taxes or your business is paying taxes, what types of taxes are imposed? And they're really not that different than any other state. The ratio might be different, but as we see here on this next slide, just comparing ourselves, looking over the border to North Carolina, property taxes, sales taxes, individual income taxes, corporate taxes, and then other taxes. You see, it looks like South Carolina is a little heavier with property taxes. We're lighter on individual income taxes. And again, a lot of things go into this. So this is a ratio of one tax to another. So we shouldn't draw too broad a conclusion, but the point of this is we are roughly taxing our people and our corporations in South Carolina similarly in the ratio, not the level, but similarity in the ratio to our other Carolina over the border. Then I just had to throw this in. This is not the most gorgeous graphic in the world. I think it's lifted from the Wall Street Journal. But we talk a lot about going to a 0% income tax, and we'll talk about that some more. Florida has a 0% income tax. So does Tennessee. So does Texas. But you look at these property tax hikes that have taken place, and this is from last year, but the list is hit with a lot of Florida cities: Jacksonville, Tampa, Miami, Fort Lauderdale, Orlando. Let's see, that's all the Florida cities, but you see that the property taxes have grown up dramatically. Of course, there have been efforts recently announced to try to get rid of not only the sales tax, the income taxes currently, but the property tax also in Florida. So that's going to be a challenge because already it's kind of blowing back on Florida, but they have an entirely different economy from ours. So looking next to sales taxes, South Carolina imposed an additional 1% sales tax as a part of a property tax rollback. If you look there compared to roughly 10 years ago, and there's a 1-year lag in these numbers, you look at sales tax, the average for the states that are in the southern region is about 5.4, and we're at 6 as far as the state sales tax itself. But take a look at that state plus the average local. Talk about this shortly some more, but South Carolina local governments are able to add to the sales tax as well for local purposes. So then you're seeing it jump up to 7.5 when you're looking at state and local, but we're still below the average for the region because some other states, look at Alabama, their statewide sales tax is 4, but the state plus local is 9.3. So they are really doing a lot locally with sales taxes, which we're doing too much of, I think, but maybe we're not doing as much as some other states as far as squeezing the local taxpayer. The one reason for that difference in the state versus state and local that you're actually paying when you're paying sales tax is we have local option sales taxes that the people of that municipality or county, known as the subdivision of the state, must approve on accommodations, mostly hotel rooms, roads, capital projects, school construction capital projects, tourism development, which is sort of advertising to try to get folks to come and vacation in your fair city. Property tax abatement, so rolling back property taxes. So you can get up to about 14% in a couple of places in sales taxes when the state sales tax is only 6. So you see those 1%, those local options, they can really pile up. Something that we've got to think through, we've got to address at some point. It's going to be difficult and it's going to cause a lot of angst, but we're taxing goods in South Carolina broadly, but we're not taxing services broadly. So as our economy is moved more to a service economy, we're really not fairly taxing items that should be taxed. If we were to lower the tax and tax more, we would have a fairer, flatter tax, and actually people would pay less in taxes if it were broader. So we have this 4.4 billion in tax revenues that are out there that are not being taxed, that are causing the tax rate on what we are taxing to be too high. So lower and flatter is really where we need to go with sales ultimately. The individual income tax, probably other than property taxes, generates the most conversation. If you look at the South, look at our competitors for economic development, you'll see 2 states have no individual income tax. 3 have a graduated tax, which means they're different levels depending on income, but 3 have a flat rate. So, got to talk about this some more, but South Carolina has gone down from multiple brackets to only 3 brackets, and we've gone down over time from 7 to 6, so we're now at 6. Our rate is not calculated the same way. Remember, we talk about the way we start with the basis of how we calculate our tax in South Carolina is different than some of these other states, which makes that 6 look a little bigger than it actually is in effective or actual rate that's being paid. But still, it screams out at that. Look at that chart there. It just screams out at you 6%. So we've got to do something about that, and we're going to talk some more about what we're doing. The individual income tax full picture, and these are as of recently here. You have different standard deductions. You have different places where the highest rate begins, and you have different income starting points. As we've said already multiple times, we base the starting of the income tax calculation on federal taxable income. We're one of 5 states who do it exactly that way. 32 states use federal adjusted gross income, and that's much more standard. And that's what North Carolina and Georgia uses. Their highest rate begins at 0, and their standard deductions are different. So that's why when you come down to the actual what's being paid, sometimes even though we're at 6, they are at 4.25 and 5.39. The actual that's paid, we are slightly more competitive than this may appear. So next of all, and as we continue on this item, um, there's no blinking at the fact that if we don't change, if we don't reduce our individual income tax, we're going to be looking around at our neighbors and they're going to be at 0, 0, 3.99, and 4.99, and we're going to be at 6. So that's not competitive. Also, I'll just throw this in. It's not necessarily a part of our agenda, but if you're trying to incentivize or incent marriage, there is a marriage penalty that exists in South Carolina's code, and that just simply means married taxpayers filing jointly are less than double the bracket widths that apply to single filers. So it doesn't benefit taxpayers to be married when it comes to paying their taxes. So that's something that we could look at eventually, that we've looked at before. We probably need to take a look at again. So the South Carolina House tax bill, bombshell. It was the talk of the state. The lobby was filled as 4216 was rolled out. The effect of 4216, which did pass the House of Representatives, will be to shift from that 3 brackets. Remember, we were at 5 brackets, now at 3, 6, 3, and 0. This would shift to 2 brackets, 5.39 and 1.99, and then that higher rate, that 5.39, would apply to income above $30,000. So that would be different from what we have now. But as you see, there's also no 0% rate. The lowest rate would be 1.99. Now, an interesting twist to the bill is it requires revenue growth projected by the Office of Revenue and Fiscal Affairs, Bureau of Economic Advisors. We would have to have 5% growth to trigger that tax relief. And then 200 million or 25% of the recurring surplus would go to that income tax relief. So that would be a requirement. And I think if you look at the second part of that sentence, that bullet point there, 25% of the state's recurring general fund surplus. So there are different ways of having a surplus. One way of having a surplus is to take more in taxes and keep your spending the same. The other is for the state government actually to reduce spending, which creates additional surplus. It's just basic math. So if the state wanted to speed up these tax cuts, these individual tax cuts, any way of creating that surplus, more in tax revenue, reducing spending, or both, would make it happen faster. The goal, of course, is to get to 1.99% flat, eventually 0, but going to that 1.99 so that the two-tiered system, which would apply 5.39 and 1.99 depending on income, would go to 1.99 for everyone, no matter what their income. Now, currently, of those states that have an individual income tax, Arizona is the lowest at 2.5. So if South Carolina could achieve 1.99, of those states that have an income tax, we would be the lowest. Of course, the goalposts keep moving here. I think there are going to be many other states that are going to be passing tax relief as far as individual income tax relief. So every time we make a move, Georgia's going to keep moving. North Carolina's going to keep moving. Even Mississippi now is finally catching up. So we've got to be aggressive because, again, the Southeast is the place where the tax cutting is the most aggressive because people are coming here. There are more taxpayers causing the ability to reduce the rates. So, corporate taxes. I'm not, as we saw earlier, it's not a significant part of South Carolina's tax revenue. We do have a 5% tax. It's roughly in line with what other states are doing. North Carolina is definitely going to 0. They've gone from 6 to 2.25. They've already set a path to 0 a number of years from now, but in the short run. Actually, they will be at zero. It seems to me that if we're looking at tax cutting, corporate taxes, that's an easy one. If we were to go to zero and set our clock to the same time as North Carolina, then that would be really strong for economic development to reduce corporate taxes. Another, and this is what the Tax Foundation, they said we're reasonably competitive with that flat rate of 5%, except we have all these tax credits that are one-offs from that. Instead of a broad-based tax relief, we kind of choose winners and losers. Tax Foundation also says that we should not have this capital stock tax, which we didn't really cover here, but the capital stock tax is based on a business's net worth. It's relatively low, but it is annoying for businesses to have to keep track of this. It's a throwaway. It's something that would not cause that big of a dent, I don't believe, in our revenue, so it might be a good time for the stock tax to go. Then we look at property taxes. We're going to talk about Act 388 here shortly, but it's always looming when you're talking about property taxes. Here's Act 388 on the cloud, getting ready to come into play and kind of rain on our parade. But as you'll see, as far as average property taxes, it's difficult really to compare property tax levels across states. So the best way of doing it is to calculate the average property taxes paid. That's pretty good. Or the ratio of what you pay in property taxes to the value of the real estate. So that's what you're looking at here. These are taken directly from the Tax Foundation, and I'll refer you. I'll hold it up here, though you can't see me, but the facts and figures booklet from the Tax Foundation is absolutely crucial, and it has all of these numbers in it. But you can see the average property tax paid is increasing, and South Carolina is slightly more than the average. But generally, our property tax rates in South Carolina are relatively low as far as average residential property taxes compared to the Southeast. Now, one issue that we have when it comes to property taxes is the tax assessment ratio. And for some reason, we chose to put the tax assessment ratios, which is a part of that magic equation that generates the number of what you're going to pay in property taxes. We chose to put that in the Constitution. So manufacturing is the highest at 10.5, commercial 6.0, rental property is 6.0, and then owner occupied. That's the sweet spot in residential property taxes. That's 4.0, or in property taxes in general. So 10.5 manufacturing, 6 commercial, and rental property, and for your primary residence or your homestead. So just a quick walk through history here. In 1995, the legislature passed a bill removing that portion of taxes for a person's primary residence, the homestead, using that kind of arcane term, removes the operation and maintenance portion for schools from the property tax bill. So no longer is a residential homeowner paying the O&M, the operation and maintenance portion of school funding. The sales tax was raised in return to, in essence, provide those funds to the schools. 2000, the property tax rate on personal vehicles was reduced. We had a high car tax, and that was reduced. And then finally, in 2006, that was that real transformative Act 388 that finished that residential tax reduction by removing all operation and maintenance taxes for public education. So only school debt. You may notice from time to time, you'll be asked to vote in a referendum to raise funds so that school districts can sell bonds to build buildings to either build new schools, refurbish schools, build fine arts centers, other things. And that would still appear on your residential property tax. But O&M, operation and maintenance, went away with Act 388 in 2006. So that homestead exemption is a complete exemption of taxes on the first $50,000 in market value. That's for homeowners over the age of 65. We'll skip down here, a 15% cap was placed on property tax assessment increases. So property tax millage increases are limited to population growth plus inflation. And then this is the real strong element of Act 388. It specified that a 2/3 vote of the local taxing authority would be required to raise the millage cap. So there is every possible way you could think of in Act 388 to really put the screws down on residential property taxes, even to say that a local authority would have to have 2/3 of a vote to raise millage. So it was one of the strongest property tax relief and property tax limitation bills that have been passed in the country, Act 388. So the other side of this that perhaps was unintentional is after Act 388, your homestead receives that low assessment, that low rate, but rental property, if you have rental property, you're going to pay a higher rate. That's passed along to the renter. And then I say beach property here, beach property, mountain property, any second home you may have that maybe you've saved your entire life to have that second home or a small place at the beach. It's going to be taxed as a second home. It's not going to receive that low rate your homestead received. And other things about it that are things you're going to have to know if you're making changes to your lives. And that is if you make improvements to your property, that could kick in some reassessment. Transferring the ownership of the property would remove that cap on appraisals. So these are some of the outlying effects of Act 388 that we are dealing with to this day. In some cases, if you're a homesteader, you own your own home, it keeps your property taxes down, but there still is the opportunity for having oddities of the tax system that may shackle people in ways that they don't wish to be constrained based on changes that if they made them to their living situation, it would increase their taxes and their liability. So commercial property taxes, I think this quote from the Tax Foundation is really good. South Carolina's property tax code is one of extremes. It features enviably low effective rates for homeowners, particularly for those who remain in their homes for many years, as we just said, but at the expense of renters and commercial property owners. So the renters and commercial property owners are going to have those higher property tax burden. So that's the trade-off. That's the trade-off with commercial property. Manufacturing properties, we said the Constitution, there's a rate that's actually in the Constitution, and we see that there at 10.5. Again, if a commercial or industrial manufacturing property is taxed with that assessment, there's a chance at it being taxed at a very outsized rate from residential property. So over the years, the legislature's tried to put a Band-Aid on this by passing, depending on whether you want to pronounce it as if it were French or not, FILOT or FILO, F-I-L-O-T, fee in lieu of taxes statutes, that if you're creating a certain number of jobs and the job creation and investment is sufficient and the local taxing authority is supportive of it, then you can have a reduction in your manufacturing taxes. But the legislature in recent years has set aside some funding to buy down these high industrial and manufacturing taxes. In fact, the Senate this year just passed a bill raising the amount of funds that would be in that special kitty, so to speak, that special tax fund, trust fund, in order to buy down those manufacturing taxes even further. Not the rate, but the number of businesses that would be able to participate in that reduction. So that may be coming back. It's already passed the Senate. Who knows? It could be added to whatever the Senate decides to do on personal or individual income taxes. So now we move along to some other taxes that you may not think about generally, but technically they are taxes. And we'll just take a look at those very quickly here. We have the unemployment insurance tax. I don't know if you followed this in the news or not, but South Carolina right now, as of just a couple of weeks ago, has a $1.8 billion unemployment insurance trust fund. 1.8 billion. And simply what's been happening is businesses have been paying into this trust fund so that there will be funds there to pay unemployment claims, but unemployment claims have been low. So this trust fund is built up every year. It just continues to grow. It is now at 1.8 billion. So Governor McMaster just reported that his department was going to be cutting the rate that businesses pay. And again, he's cut it every year he's been governor, and you count it back, it's at least 13 consecutive years that the rate has been cut, but the fund still continues to grow. So this has not always been the case. Our unemployment insurance trust fund at one point was kind of on tenterhooks. It was not, there wasn't a balance like this, but changes to that system have caused that to have a very healthy balance, and that's led to these rate cuts. Now, in state and inheritance taxes, there is a federal estate tax, but the 12 states, in addition to the DC, have in estate taxes or inheritance taxes. South Carolina does not have an estate or inheritance tax. So just to make you aware of something that we don't have, that some other states, or many other states do. The business license tax. Now, this was a reform the General Assembly passed in 2020 that made a lot of businesses, even some very small businesses, made their lives a lot better and a lot simpler. This was the Business License Standardization Act. It set standards for business license taxes. I don't know if you had been maybe driving down the road and you see a truck of someone performing some type of construction work, and the truck itself would have multiple permits for all the many municipalities that company or that individual might, on which he might be, she might be working. This standardized that and prevented double taxation, set up an online payment system for business taxes, and really straightened out a problem that had been lingering for quite a long time. So Act 176 in 2020 was an outstanding piece of legislation to help businesses operate more efficiently and not be double taxed in some cases. So some other fiscal policies in the state of South Carolina. We're kind of rounding the bend here toward the end of our presentation, but we'll take a look at some of these other fiscal policies in the state of South Carolina now. These are some items that we added for this year's presentation, and somewhat reluctant to add these statistics because in some ways they may raise more questions than they answer. But if you look at the South Carolina state budget, you look at the most recently completed fiscal year. That's what these numbers are for. You will see recurring general funds of $12.42 billion. You'll see non-recurring funds, that's one-time funds of 1.64 billion. You'll see the capital reserve funds, that's sort of our savings account for one of our savings accounts for rainy days. Then that gives you the general funds. Then you see federal funds. So these are matching funds that we receive for various federal programs, other direct federal investments in South Carolina. Then other funds to many are kind of a mystery, but I'll give you an example of other funds. The tuition that's paid to state colleges and universities. So all of that tuition money, that would be considered other funds because it's not a tax, but it's funds that comes into an entity that is an arm of the state of South Carolina. So it looks like a huge number when you add all of that. Then you're looking at 42.26 billion. But that's slicing it in the most intricate way so that you can see where those funds are, or those appropriations are by source. If we look at that slightly differently in the way that we had earlier on, where we're looking at the different types of taxes, and this gets us a much lower number because it doesn't include federal funds, other funds, some of these other things the previous slide showed. But if we look at what the state received from individual income taxes, 5.31 billion, sales and use tax, 4.79 billion, corporate income tax, roughly 1.3 billion, other, and there's a long list of small miscellaneous taxes in the fine print that would describe other taxes, and then other revenue, and then the core state budget from those taxes is 12.9, roughly 13 billion. So that's where we are as far as the revenues and where they come from, or where they came from. I don't know if you're aware of this, but there is a constitutional spending limit, and the Office of Revenue and Fiscal Affairs in the state government keeps track of this. The constitutional spending limit is 31.36 billion, and the way that the Constitution lays it out, it gives you a calculation based on general fund appropriations, the Highway Trust Fund, you've got to remember this was a while ago when it was passed, and Education Improvement Act funds, which leaves you with an additional capacity for spending of 15 billion. So I think what I take away from this is the constitutional spending limit really is not much of a limit. You know, the state of Colorado has something called TABOR, TABOR. That's a very aggressive limit on state spending. This constitutional spending limit, to me, just judging it based on these numbers, looks like it was a really good idea, but the leftover capacity for spending, the state could still meet the constitutional requirement and spend 15 billion more dollars. I'm not sure that's the kind of limitation that we were really looking for. So perhaps in the future, we should take a look at this and make it something a little tighter that would follow more the growth in the economy, the growth in population, inflation, these types of calculations that would give us a little more realistic limit. You're probably also not aware that the state constitution has a limit on the number of state employees, and it's based on the state population increase. And again, not a great calculation, because based on this, we have appropriated positions in state government of about 38,000 employees, which means we have the capacity of hiring 28,000 more. So we could almost double our workforce if I'm reading these numbers correctly, and I think I am. So if we do want to place a limit on state employees, there's maybe some adjustments that would need to be made to that provision, limiting full-time equivalency, or FTE, state employees. Something that we did recently in the 2022 general election, we call this rainy day funding. In 2022, we passed two constitutional amendments. They were very similar. One raised the general fund reserve fund from 5% to 7%. So we would take a higher percentage of the state budget and save it for a rainy day. And there was another rainy day fund called the Capital Reserve Fund, and it raised that fund from 2% to 3%. So now we're setting aside, just with these two funds, a total of 10% for events like an economic turndown or a natural disaster, so that we will have those funds if we need them. And this does not include some other contingency funds that have been created. So when the state government's revenues increased dramatically with the growth in the economy, the state spent more, but the state also started saving more by creating some new contingency funds to save for a rainy day. And the most significant ones, or most well-known ones, are the Capital Reserve Fund and the General Reserve Fund. So one item that the National Association of State Budget Officers tracks, and this is a very arcane measurement, but I've always found it very interesting, and that is, if the state of South Carolina were not to take in another dime tomorrow and was forced to operate only on its contingency funds, its rainy day funds, how long could the state government operate? Now, that's kind of a nonsense calculation, because the state not taking in a dollar makes no sense. But look at Wyoming. Wyoming, 320 days. Wyoming has saved enough over time that they can operate for 320 days on rainy day funds alone, which is an incredible record. Of course, this is somewhat controversial, because there are those that say, why should government be hoarding our tax money? The state of Wyoming needs to lower its taxes and not collect so much for a rainy day and let the people keep those funds. So it's a controversy. It's a very interesting debate that takes place. When South Carolina raised its contingency fund percentages, that was a debate that was in place. Looks like the 50-state medium for rainy day funds alone is 47 days, and we're at 39, so we're roughly the median, close to the 50-state median. And then another way of calculating is, how long could the state operate on total balances, not only rainy day funds, but leftover funds from state agencies. And it looks like we could operate for about 149 days. And if you rank the states in order of how many days the state could operate on total balances, rainy day plus carryover funds, we would be at the 11th in the nation for how long we could last. The median is 80, and we are at 149. So that's just a story about our contingency funds and some sort of fiscal accountability and looking out for a rainy day. That concludes our report for today. I think this has been a grand tour through not only taxes, but some touching on the budget. We would like to do more on the budget as time goes by and as the legislative session approaches. So you'll see more on budget analysis, but I hope this has been useful to you in getting a sort of a grand tour of how South Carolina's fiscal policy works, where the funds come from, to some extent where they're going, though we want to do more on that, but definitely where the funds come from, and the whole idea of conformity. This one big beautiful bill was so significant when it passed. It creates all of these questions that our state legislators and tax analysts must answer. And that is in our future to determine how we're going to react. And again, since we have static conformity, we can pick and choose what we want to conform to, where we want to connect with IRS code or couple, and where we want to decouple, and where we want to do something else that we think would be better for South Carolina. But that is the general story of tax and budget. A number of the figures that we have quoted for you today, which we did not footnote simply to keep the slides simple. They came from a marvelous document from the Tax Foundation called Facts and Figures, How Does Your State Compare? This is available online. And if there are any errors that we made in transcribing these numbers, we certainly apologize, but we have checked and rechecked. We think the numbers are correct. But I just really recommend this to you, see if you can get out of the glare. But you can see all of the data about taxes at the Tax Foundation. Really, they stand out above others in their ability to track all tax issues and their reaction to the One Big Beautiful Bill and what that means for taxpayers in South Carolina and across the country. Also, the Office of Revenue and Fiscal Affairs, which is a part of state government, they collect most of the statistics related to the budget and fiscal affairs for the state, and all of those numbers are available not only to see as a document, but to download. You can download the numbers. You can manipulate them any way you want to see trends. So the Office of Revenue and Fiscal Affairs recommend both of those, Revenue and Fiscal Affairs in state and the Tax Foundation out of state, to keep track of these numbers. Well, I don't know if we have any questions. We have an opening here for a chat in our web chat, but if not, thank you so much for being with us today. And if you are watching this delayed in a recorded manner, any item that we discussed today, we would much like to discuss with you more in depth. Perhaps you have an item here that we've discussed that we touched on very lightly that you would like to have a much more in-depth understanding of. And if we don't know the answer, we will certainly find the answer for you. So thank you for being with us today here on this policy presentation. I ask you to take a look on our website for the other items in the Freedom Agenda and look at the other presentations on other issues that will be posted along with this presentation on other issues like education and healthcare. Thank you again for being with us, and give us a call if we can be assistance to you in any way.